School of Finance, they would freak out. But this is how I think about it, where you have those that want to buy bonds. There's a bidding war for them. The more people want it, the more price goes up. The less people want it, price goes down, supply and demand. But then there are those that are selling bonds. And they need the money. When they sell a bond, they're actually borrowing money. So whether it's the government, like in a T-bond or T-note or T-bill, or what if it was Ford Motor Company or General Electric? They issue bonds as well. General Electric says, look, we need to borrow some money. Okay, how much? Well, I'll lend you, $10,000. You'll pay me back in 2 years, and you're going to pay me a certain percentage on top of that. All right, so that's what it is. So sometimes when there are not enough people to loan them money, they'll have to offer better terms to attract people to them, because they need to borrow the money. So if 5% is not enough to attract the money they need, then they have to be willing to pay 6% or 7% until somebody steps up and says, okay, General Electric, I'll lend you the money at 7%. Okay, so there's supply and demand on both ends. And I think this is very interesting. Now I bring up General Electric and Ford, which is away from the Treasury discussion, because this is a normal part of doing business. Okay, when you're General Electric and you need to build a factory, that costs money up front. Okay? Or once the factory is built, then you have to hire a whole bunch of employees, and then you have to train them all. That's expensive. Okay? And then an order comes in. $1 billion order for jet airplane engines from the military. The military is going to pay, General Electric is going to make the money. Do you think the military pays up front? No. So how does it all work? Well, they get the order, and over the next 2 years, they're going to make $1 billion worth of airplane engines for the military. But there's significant capital costs to get that going before they get the first paycheck from the government. So they go out to the open market and say, look, we have $1 billion order, and we need $250 million for the first wave, right? We'll get paid, but we need to hire some more people. We need to tweak some of the manufacturing equipment, and we need to buy raw material, and we need to build some of the first airplanes and airplane engines, and then we'll deliver them in 3 months to the military, and then they'll pay for them, and then we'll have money. So we need to borrow, right? So they go up to the open marketplace and they want to borrow some money for 3 months until they get paid. So they're good for it, but it's a cash flow issue. Now this is normal. This is a normal part of doing business. If you sell shoes, you need to buy inventory before you get paid, right? And you got to advertise before you get paid, and you have to have a retail space before you get paid, and you got to have trained employees before you get paid. A lot of things happen before revenue kicks in. Expenses always front run the revenue. So businesses in a normal day-to-day operation borrow money through the bond market. Nice. So what happens though if they're having trouble finding the money? They're going to have to pay a higher percentage, right? A higher yield. Where does that money come from? If it costs 7% to borrow the money, where does that 7% come from? No, if it costs 7% to borrow the money, it's another cost, isn't it? How much does it cost to build your inventory? How much does it cost for shipping? How much does it cost for rent and salaries and insurance? And then how much does it cost to borrow the money? It just all goes in. It's a cost of doing business. So it comes out of the profits. You better charge enough to cover this expense, right? So here's an interesting thing when it comes to the yield curve. Okay, let me do some drawing here. Let me sit down. So there's a relationship between price, supply and demand, and yield, supply and demand, from those buying and from those selling the bonds. Okay? So the theoretical yield curve would be something like this. Y-axis percentage, x-axis time, let's just say. Okay. If you wanted to borrow some money overnight, okay, General Electric needed to borrow money, and they'll pay you back tomorrow. How much risk is there? And they do this, by the way, guys. They do this with the banks all the time. Yeah, very little. They have a credit rating, and they've been doing it every day for years. And again, it's just to do things like keep the phone lights, the lights on, and pay the phone bills, and you know, taking the sales team out to strip clubs and stuff like that. So very little. But what if you had to lend General Electric money for 30 years? Yeah, because lots can change. Not just General Electric, but the value of your money. And you're going to have to pay for that, right? If you need to borrow that kind of money. So a lot of people are freaking out because they still have 6% mortgages. And they don't have the credit or equity to borrow at a lower interest rate. They're freaking out, right? And they still have 20 years left on their mortgage. And they're like, man, this high interest rate's killing me. Well, 10 years from now, their mortgages could be 12% in the United States. How are those people going to feel locked in at 6%? Now they think they're smart. So lots of things can happen over the course of time. The more time, the greater the risk. And like I said, the value of your money, your purchasing power of your money could significantly change over that time frame. So traditionally what we're hoping for is a 45-degree, nicely flat curve here, slope curve, a little slope here. So the money overnight is very little risk. All right, so let's just say 3 months instead of overnight. Okay, 3 months. Okay, from 3 months to 3 years. The longer the time, the more the risk. So let's do some basic logic here. If you were going to lend General Electric money for 3 months, should you earn a high return on investment or a low return on investment? Low, and why is that? This is very short term, and more specifically, you're taking on a lot less risk. Now, this is where credit ratings come in, okay? Well, what kind of risk over the 3 months? Well, a AAA company is very low risk. A AA company is a lot more risk. A minus BB is junk bond. So a junk bond company would have to pay you a lot more in yield. It's still short term, but it's a higher risk. So it still comes down to, how much risk you're assuming over that time frame. But if you take a pretty, let's say, a AAA, blue chip company, overnight for a short-term investment, you're accepting very little risk, and you're willing to accept a small profit for essentially doing nothing, right? But if General Electric wanted to borrow for 10 years, they would have to pay you significantly more because now you have time as risk as well. And then 30 years. So the longer you lend the money out, the more risk you're taking because now as an investor, you can't look at other deals because you've spent your money already. You've given it to General Electric. So you're locked in. Now you might be guaranteed, but you're assuming risk. Risk that the company fails, risk that the value of the money they're paying you doesn't keep up with inflation, etc., etc. So the more risk, the more return. Or to say it differently, it'll be a lot more difficult for General Electric to find people that are willing to give them 10 or 20-year loans. So if they need that for whatever reason, they're going to have to pay more to attract those people. Well, I'd be careful. This time of day, if you're buying cable, if you're blowing through the 15-minute 5, then you're going to pull back to the hourly 5. Just be careful. The European markets are closed, so it might be end of day. But look at oscillators on the short term. Look at moving averages on the short term. Okay. Going to the question. Yeah. Where are you from? Korea? Is that the Korean name?